In the world of high finance, a select few are known for their daring bets and seemingly superhuman abilities to manipulate the market. But there's one name that stands head and shoulders above the rest: George Soros. On September 16, 1992, also known as Black Wednesday, Soros made $1 billion by betting against the British pound, effectively breaking the Bank of England and cementing his place in financial history. But who is this man, and how did he amass such wealth and power? Born in Budapest, Hungary in 1930, Soros lived through the Nazi occupation during World War II and the subsequent communist takeover. These early experiences shaped his worldview and fueled his desire to succeed in business and make a difference in the world. After fleeing communist Hungary and studying at the London School of Economics, Soros began his career as a stockbroker in London. He later moved to New York City and founded his own hedge fund, Quantum Fund, in 1973. Over the next 4 decades, Soros would become one of the most successful investors in history, with an estimated net worth of $8.6 billion as of 2021. Soros' investment strategy is based on his reflexivity theory, which posits that market prices do not always reflect objective reality, but are instead influenced by the perceptions and actions of market participants. This allows Soros to identify and exploit mispricings in financial markets, often earning him huge profits while infuriating his critics who accuse him of manipulating currencies and stocks for his own gain. But it was on Black Wednesday that Soros truly made his mark on the financial world. By betting against the British pound, which was then part of the European exchange rate mechanism, Soros saw an opportunity to profit from a mispricing in the market. The ERM required countries to maintain their currencies within certain limits, but as inflation rose in Britain and interest rates increased, the pressure on the pound became too great. Soros and his team at Quantum Fund saw this as a chance to make a massive profit by shorting the pound, effectively betting that its value would fall. As more and more investors followed Soros' lead, the British government was forced to abandon the ERM and devalue the pound, resulting in huge losses for the Bank of England and a massive payday for Soros. In this series, The Money Trail, we will explore how George Soros made his fortune, the impact he has had on global financial markets, and the controversies that have surrounded him throughout his career. So join us as we delve into the hidden world of high finance, where fortunes are won and lost in an instant, and one man can change the course of history with a single trade. In the late 1980s, a new monetary system was taking shape in Europe, one that would forever change the continent's financial landscape. This was the European Exchange Rate Mechanism, or ERM, an agreement between member states of the European Economic Community to restrict fluctuations in their currencies' exchange rates. The goal was to promote economic stability and facilitate trade, but as we'll see, it would also create a golden opportunity for those savvy enough to exploit its weaknesses. The ERM was launched in 1979, but it wasn't until the late 80s that it really gained traction. By 1990, 11 European countries had joined, agreeing to keep their currencies within a narrow band of fluctuation around agreed-upon central rates. The British pound, for instance, was set at a rate of 2.95 Deutsche Marks, a decision that would later prove fateful for the UK economy and one man in particular. The architect of this new system was the German Bundesbank, which saw the ERM as a way to export Germany's low inflation rates across Europe. By pegging other currencies to the DM, they hoped to import price stability while maintaining their economic dominance on the continent. But there was a catch. If any country experienced an imbalance between its domestic monetary policy and the requirements of ERM membership, it might be forced to raise interest rates or cut government spending, policies that could trigger recession. This vulnerability would not go unnoticed by speculators like George Soros, who saw in the ERM's rigid rules an opportunity to make a killing. By betting against currencies he believed were overvalued, Soros could potentially force governments to devalue their currencies and reap enormous profits in the process. Little did he know that his biggest payday was just around the corner, and it would come at the expense of the Bank of England. As we'll explore in the next section, Soros' gamble on the British pound would not only earn him over $1 billion, but also expose the fatal flaws at the heart of Europe's grand monetary experiment. Stay tuned as we continue to follow The Money Trail. In the early 1990s, George Soros, a Hungarian-American investor, had his sights set on the Bank of England. The target of his ambition was the British pound, one of the world's most powerful currencies and a cornerstone of the European exchange rate mechanism. Established in 1979, the ERM aimed to reduce exchange rate volatility among its member countries, ultimately paving the way for the introduction of the euro. However, Soros saw an opportunity to exploit vulnerabilities within this system and make a fortune in the process. The ERM operated by pegging each member's currency to a specific value relative to other currencies in the mechanism. To maintain this exchange rate, countries would adjust their interest rates or intervene in the foreign exchange market by buying or selling their own currency. By joining the ERM, Britain committed to keeping the pound within a narrow band of 2.7% above or below its target value against other ERM currencies. This commitment required the Bank of England to maintain the pound's value through intervention and interest rate adjustments. Soros recognized that the British government was struggling to keep the pound within its designated range due to high inflation rates compared to other ERM countries. To meet the criteria for joining the ERM, Britain had implemented drastic austerity measures in 1979, which initially brought down inflation but left it persistently higher than its European counterparts. As a result, maintaining the pound's value within the ERM required increasingly high interest rates, putting a significant strain on the UK economy. Soros and his team of analysts saw an opportunity to profit from this situation by betting against the Bank of England's ability to maintain the pound's value within the ERM. They believed that Britain would eventually be forced to devalue the pound or withdraw from the ERM altogether. By short-selling the British pound, Soros aimed to make a fortune when the currency's value inevitably declined. As we'll discover in the next section, Soros's audacious bet against the Bank of England would not only earn him over $1 billion, but also expose the ERM's inherent weaknesses, leading to its eventual collapse and reshaping Europe's monetary landscape forever. Join us on The Money Trail as we delve deeper into this fascinating story. In 1992, on a day that would later be known as Black Wednesday, marked a turning point in financial history. The Bank of England, one of the world's oldest central banks, failed to defend the pound, resulting in its withdrawal from the European exchange rate mechanism. This event had far-reaching consequences not only for the British economy but also for global currency markets. The ERM was an agreement between member states of the European Community aimed at reducing exchange rate volatility and stabilizing currencies in preparation for monetary union. The UK joined the mechanism in 1990, committing to keep the pound within narrow bands relative to other ERM currencies, such as the German Deutschmark. However, on September 16, 1992, also known as Black Wednesday, billions of pounds were spent by the Bank of England in a futile attempt to prop up the currency's value against speculative attacks. The bank's efforts proved unsustainable when faced with the financial might and cunning strategies of renowned investor George Soros. Soros had taken a massive short position on the pound, essentially betting that its value would decline. By selling vast amounts of sterling, he exacerbated the pressure on the Bank of England to buy back pounds and maintain its peg to other ERM currencies. Eventually, the bank was forced to abandon its efforts and withdraw from the ERM, causing the pound to plummet. This decision cost UK taxpayers dearly, an estimated $3.4 billion in one day alone. Meanwhile, Soros's quantum fund reportedly made over $1 billion in profits, earning him the moniker the man who broke the Bank of England. Black Wednesday exposed critical flaws within the ERM and hastened the move towards a single European currency, the euro. It also demonstrated the immense power wielded by influential investors like Soros, and served as a stark reminder of the potential pitfalls when nations tie their monetary policies too closely to one another. In our next segment, we'll explore how George Soros' audacious bet against the Bank of England not only earned him over $1 billion, but also exposed the ERM's inherent weaknesses, ultimately reshaping Europe's monetary landscape forever. Stay tuned for more on The Money Trail. In the world of high finance, George Soros is a legend. His bet against the British pound on Black Wednesday, September 16, 1992, would earn him over $1 billion and etch his name in financial history. But this audacious move did more than just line his pockets. It exposed critical weaknesses in the European exchange rate mechanism and reshaped Europe's monetary landscape forever. The ERM was designed to limit fluctuations between participating European currencies, aiming to maintain stability while moving towards a single European currency, the euro. However, by pegging the British pound to the German Deutschmark, the Bank of England inadvertently tied its monetary policy to Germany's, which was then focused on fighting off inflation post-reunification. Soros saw an opportunity here. He believed that the pound was overvalued and that Britain would eventually be forced to devalue it. So he began selling pounds, about $10 billion worth, in a process known as short selling. As the value of the pound started to drop, Soros continued to sell, further driving down its price. On Black Wednesday, the British government, realizing the severity of the situation, withdrew the pound from the ERM, devaluing it by around 15% against the Deutschmark. This decision cost UK taxpayers an estimated $3.4 billion in one day and allowed Soros to buy pounds back at a much lower rate, making him over $1 billion in profit. This event sent ripples through global finance. It demonstrated the dangers of fixed exchange rates and the power individual investors can wield. Moreover, it hastened the move towards a single European currency, as countries sought to avoid similar vulnerabilities. Today, the euro stands testament to that shift, embodying the dream of a unified European economy forged in the crucible of financial crises like Black Wednesday. Yet, even now, George Soros' name invokes mixed reactions, admiration for his financial acumen, yet unease at the immense influence one man can have over nations' economies. His billion-dollar bet serves as a stark reminder of the delicate balance between national sovereignty and international finance, a tension that continues to shape our global economic order. That's all for today's segment on The Money Trail. Join us next time as we delve deeper into the labyrinthine world of international finance, where billions are made and lost in the blink of an eye. Until then, stay informed, stay curious. Surely, the story of George Soros' audacious bet against the Bank of England in 1992 is one for the history books. The event, which has since been dubbed Black Wednesday, saw the Hungarian-American financier rake in an astounding $1 billion in a single day while simultaneously dealing a devastating blow to the British economy. But as we've seen throughout this series, the world of high finance is rarely black and white. Soros' move, while undeniably brilliant, has sparked heated debates about the ethics of his actions. Critics argue that his bet amounted to exploiting the economic woes of an entire nation for personal gain, further exacerbating Britain's financial struggles at a time when it was most vulnerable. On the other hand, supporters of Soros contend that his trade served as a much-needed wake-up call to the Bank of England and the wider international community. By demonstrating the potential consequences of mismanaging currency markets, Soros arguably helped to strengthen the global financial system by encouraging greater vigilance and more robust risk management practices among central banks and other key stakeholders. Moreover, it's important to remember that Soros himself has long been a vocal advocate for open societies and the rule of law. He has used his vast wealth to support numerous charitable causes and progressive political movements around the world, earning both admiration and ire in equal measure. So where does the truth lie? Was Soros' move on Black Wednesday an act of financial genius or a morally dubious assault on a struggling economy? As with so many questions in the world of high finance, there are no easy answers. But one thing is clear, the events of that fateful day will continue to reverberate through the annals of economic history for generations to come. As we conclude this segment of The Money Trail, it's worth taking a moment to reflect on the broader implications of Soros' actions. For while his bet against the Bank of England may have made him a billionaire overnight, it also shone a spotlight on the delicate balance between national sovereignty and international finance, a tension that continues to shape our global economic order. Join us next time as we delve deeper into the labyrinthine world of international finance, where billions are made and lost in the blink of an eye. Until then, stay informed, stay curious. The Money Trail has traced the footsteps of a financial coup that etched George Soros' name in the annals of economic history. On September 16, 1992, so-called Black Wednesday, Soros bet big against the British pound, engaging in a high-stakes gamble that would eventually earn him an astounding profit of $1 billion. But what can we learn from this episode, as we continue to navigate the treacherous waters of today's financial markets? For starters, speculation and risk-taking are inherent aspects of international finance. They always have been and likely always will be. Soros saw an opportunity and seized it, exploiting market inefficiencies to his considerable advantage. However, the story also serves as a stark reminder of the need for effective regulation and oversight. When left unchecked, speculative activity can undermine national sovereignty, destabilize entire economies, and inflict real suffering on ordinary people. This tension between market freedom and government intervention remains one of the defining challenges of our time, a delicate balancing act that demands vigilance, expertise, and a steadfast commitment to the public interest. As we move forward, it is crucial that we learn from past experiences like Soros' bet against the pound. We must strive to build financial systems that are more transparent, more accountable, and better equipped to weather the inevitable storms of market volatility. Above all, we must remember that behind every dollar sign and balance sheet lies a web of interconnected relationships between governments, banks, businesses, and individuals that can either strengthen or undermine the fabric of our global community. As we conclude this episode of The Money Trail, we are reminded once again of the stakes at play in today's complex world of international finance. The choices we make, as policymakers, investors, and citizens, have far-reaching consequences that can shape not only our own lives, but the lives of generations to come. So stay informed, stay curious, and above all, stay engaged. For it is only through vigilance, understanding, and collective action that we can hope to build a financial system that serves the needs of all, rather than just the privileged few. Until next time, this is your financial investigative journalist, signing off from The Money Trail.